Let's continue with everybody's favorite topic, bonds. Okay, bonds are a big deal, all right? I know they're kind of boring. When we think about how things are financed and the way companies are born in the United States, bonds are the starting place for a lot of really important businesses. And the bond market's a big deal to individual investors. Your retirement account will likely have a lot of bonds in it as you get closer to the end of your career. So it's useful to know it both from a business standpoint as a personal investor. Okay. So let's talk about the bond market here. All right, obviously the bond market has two sides, okay? It's got the borrowers and it's got the savers. So we can think about it in this fashion. Interest rates, quantity of loanable funds, savers curve, borrower curve, okay? And so this is our market for bonds in the interest rate setting that we have become accustomed to in this class. And this market does operate pretty much at equilibrium, which just means if you want to buy a bond, you can sell a bond, and if you want to buy a bond, you're able to do that. And if you want to sell a bond, you can do that too. And this is totally consistent with reality. If you own Coca-Cola bonds or U.S. governmental bonds, you can sell them incredibly fast, you can buy them incredibly fast, and the price is extremely consistent throughout the market, okay, at any given moment. So that works. We could think about everything in terms of savers and borrowers, okay, but I think it's a little easier and more practical to adjust this to thinking like a regular goods market, all right? So rather than thinking about this as a market for savers and borrowers that are exchanging loanable funds, let's think about the bond as an asset that's being sold, okay? So in this case, we're going to have supply and demand in this market, okay? And this is going to change the parameters, but the conceptual ideas are pretty much the same. Really what we're doing here is we're flipping the supply and demand curves on these graphs, all right? In the case of the bond market on the graph on the left, the savers curve here is represented by the supply of funds, okay? The higher the interest rate, the more likely the savers are to save money in this market. On the other side of the market, when we think about it in terms of supply and demand for an asset, for this side of the market, the demand is the savers, all right? They desire to buy bonds. They demand bonds. And the lower the price of any given bond, the more likely they are to buy it, okay? So you might recall from prior videos that when the interest rate goes up, the price of bonds goes down, all right? And obviously the other way around is true. The interest rates go down, the price goes up. So these are going to have completely reverse y-intercept effects here, okay? So when we think about the value of interest rates or price, they move in inverse relationships to one another, all right? On the other side of the market, okay, we've got our savers. The other side of the market, the borrowers are represented here. So the demand for loanable funds is the borrowers. That's the people that are issuing bonds. So we can think about these as being borrowers, or we can think about them as the supply side of the market. Okay? So why do we make this adjustment? All right, well, for one reason we make it is because it is simpler to think about it this way. But there's another reason too. I don't know if we formally defined these terms in the past, but there's really two types of financial markets. Okay? If we think about all the different markets that are out there, whether it be stocks or bonds or what have you, there's two versions of that market. One, there's the primary market. So in that case, in the primary market, this is when bonds are first created, okay? In this market, those that are supplying bonds are the borrowers, okay? And so that graph on the left, the graph on the right, they pretty much tell us the same thing. But in reality, when we think about bonds, there's going to be a mix of primary market bonds and secondary market bonds. And so for the secondary market here, all right, the secondary market represents the resale of bonds. And bonds get resold quite frequently, all right? So if you think about your financial account, let's say you have bonds in your account a 401k or something like that. If you decide you don't want bonds anymore, you're not going to wait until the bonds mature. Instead, you're going to sell them to another investor. A lot of these bonds can be 10 years long, 30 years long when it comes to governmental bonds. So it's very likely that you'll sell those bonds before you reach maturity. So what that tells you is a lot of the bonds on the market are secondary bonds, okay? And that's relevant because in this case, those that are supplying bonds are not borrowers, okay? So when we think about the supply side of the market, that's borrowers when it comes to the primary market. But when it comes to secondary market sales, those are not borrowers. Those are just investors reselling the bonds that they already have. So for that reason, it's more practical to use regular supply and demand when we think about these graphs, okay? So let's get into it here. In this market, there are 4 factors that affect the supply curve. And we're just going to run through these, and by thinking about what affects supply, we can determine what happens to interest rates and what happens to the price of bonds, the quantity of bonds, and so forth. Okay, basically this allows us to think about everything in a market. I'm just going in the order of the book. If you happen to have the book with you, you can read along here. The first thing that affects the supply curve of bonds is changes in governmental borrowing. Okay. All right. Now, the reason it's governmental borrowing and not other types of borrowing, think about some business. Okay. Think about Coca-Cola again. All right. Coca-Cola is probably not big enough to affect the overall bond market. In other words, if Coca-Cola issues bonds, okay, or buys bonds perhaps, they're not going to change interest rates substantially. They're not going to change the quantity of bonds substantially, but the government can. All right, the government is over $20 trillion in debt, and that debt comes from issuing bonds for the most part. All right, so if the government decides it's going to issue a bunch of bonds, that is going to increase the supply curve. It's a representation of the sale of new bonds. And again, this is true for anyone issuing bonds. It's just in the case of actors in this market, the government is really the only one they're going to pay attention to, okay? The government is the only one that can move the needle so far that it affects the entire market. All right, if you think about this from an economic standpoint, the government and the government alone has market power, the ability to affect the price. So, when the government buys bonds, what that will do is it will shift the supply curve to the right, leading to lower prices and a higher quantity. So more money is going to be exchanged in terms of bonds. That makes sense because they're issuing new bonds, so there's more bonds in this market. Okay. Secondly, the price is going to go down. In other words, if you're somebody who wants to sell a bond, you now have more competition. I'm trying to sell my one little bond. The government's out there selling millions of bonds. I'm going to get a lower price for my bond. Okay, the government's going to be flooding the market here. So when we think about the effects here, the price goes down. Another way of saying that is the interest rates go up, right? Because these are inversely related. If a bond that's going to pay $1,000 10 years from now goes down in price today, that means the interest rate that it is effectively paying is growing, all right? So price goes down, interest rate goes up, and the quantity goes up, okay? And that's going to be true anytime the supply curve shifts to the right. So that's one thing that affects the supply curve. Number two, looking at, again, going through the order that the book has. Number two is changes in business conditions. And this is kind of a vague one here, okay? Changes in business conditions could mean a lot of different things. But what research shows consistently, really again and again, is that when the economy is good, do you think businesses would issue more or less bonds if the economy is good? Turns out they issue more, okay? So if there is a perception, sorry about my baby down there yelling, my 1-year-old, he's wilding out. I'm having to record this one at night. So the perception of an improving economy actually increases supply. So maybe I'm thinking about starting a restaurant, and to start my restaurant, I'm going to have to issue bonds. I'm more likely to take on the risk of issuing a bond if I think my business is likely to be successful. So when people expect the economy to get better in the near future, people will issue more bonds. This is kind of like that expectations theory we saw in the past, right? If people expect the economy to get better, well, then they'll issue bonds, and that kind of helps the economy actually get better, all right? So this will do the same thing that we see over here, all right? Price goes down in the bond market, quantity goes up, and interest rates go up as well, all right? So you can kind of imagine if some people are thinking the economy is going to get better, they're kind of all thinking that. So my individual bond, where I'm thinking about starting a business to, have a restaurant, that doesn't change the bond market. But the fact that many people simultaneously have that same feeling, that can move the needle on the bond market overall. All right. So that's number 2. Number 3. Number 3 is changes in anticipated inflation. More expectations theory, right? Remember, expectations theory is just the idea that people's expectations can change reality. Same deal here. Changes in anticipated inflation, okay? Let's think about why this would be the case, all right? Imagine as someone who's about to sell bonds, imagine if I think that inflation is going to skyrocket in the future, right? I think that inflation is going to jump from 1 or 2% to 10% a few years from now. That alone, ceteris paribus, would that make me more or less likely to issue bonds today? Ceteris paribus, if nothing else changes, that would make me more likely to issue bonds. Because if inflation goes up, that means my payments in the future are lower in real terms, okay? So if inflation goes up, the real value of future payments goes down. And this is true for any type of loan, all right? Any type of bond. Now, this would affect some bonds differently. Coupon bonds differently from zero coupon bonds. A 30-year zero coupon bond, highly sensitive to expected inflation, because if there's only one payment and it's 30 years into the future, just a 1 or 2% change per year has massive effects on what the real value of that 30-year payment, 30-year maturity date actually would be, okay? So if people expect inflation to go up, they will be more likely to issue a bond. You're more likely to take out a mortgage for a house. You're more likely to borrow money for really any reason, okay? If you're the federal government, borrowing money now has effectively become cheaper in real terms. So if you expect inflation to go up, that will cause the supply to increase. And I don't need to draw it again. It'll just look like that. Prices go down, interest rates go up, and you get more bonds exchanged, all right? Number 4. And this one actually, for whatever reason, they didn't put it in the book. I'm guessing this was to try to not confuse students, perhaps. But I find it more confusing to leave it off. So I want you guys to think about inflation and interest rates as being something that you have to consider simultaneously. Okay, anytime you think about inflation, you have to think about interest rates too. We saw this when we talked about the actions the Fed takes, right? So if the Fed engages in open market purchases, that will drive down interest rates, that will drive up inflation rates in the short run, okay? Then we talked about the Fisher equation, which showed that real interest rates are basically the nominal interest rates minus inflation. Real interest rates tend to not change too much over time, which shows that inflation and interest rates over the long run tend to be correlated, okay? If inflation's really high, interest rates are usually really high too. So, we also need to consider changes in expected interest rates. As we will see in the future, this is actually something that affects demand more. So it affects the desire to buy bonds more than it affects the supply side of the market. But nonetheless, it does matter, okay? So for example, if people expect interest rates to go up, all right? Now, I'm not saying they have gone up. I'm saying imagine if people expect interest rates to go up, okay? I'm thinking about borrowing money for a house, for example, okay? If I expect interest rates to go up, am I more or less likely to borrow money now? I'm more likely, okay? Remember, a mortgage payment is just a fixed payment loan. That's one of our bonds, okay? So if I think interest rates are going to go up, I'm going to jump on the opportunity to borrow money today. I had a friend just call me up yesterday. He said he's thinking about refinancing because he heard that interest rates are about to go up. It's kind of the same sort of deal, right? He's trying to lock in a low interest rate before they go up. So what this would do is this would increase supply. All right? If you expect interest rates to go up, you're more likely to issue a bond now. You increase supply. As we saw before, that drives down prices. It drives up interest rates. Self-fulfilling prophecy here, right? You expect interest rates to go up, they do. And also you get a higher quantity, all right? So everything I've shown here has been showing supply increase. Of course, you can flip any of these, right? The government borrows less, supply would shift left. People expect the economy to get worse, it shifts to the left. People expect inflation to go down, supply shifts to the left. And people expect interest rates to go down, that would shift supply to the left, okay? And what can make this complicated and what will eventually make this difficult for you potentially on the quiz and the exam is we have to recognize that these things all move frequently, okay? These four things are basically all moving targets in reality. And these factors don't just affect supply, they also affect demand, right? If you expect interest rates to go up or down, that will affect your desire to buy bonds, just like it might affect your desire to sell. So there's the supply side. Let's go to the demand side. Okay, so now let's talk demand. Remember, demand are the people that are buying bonds. These are the people that are saving, right? When you buy a bond, you're putting money away to get more in the future, earning interest. So the savers, those are the demanders in this market. So when we think about the shape here, this is bonds. Right, there's our graph. Okay. Let's talk about, firstly, the most challenging, wealth. Okay, we're going to spend a little bit of time on this because there's this little nuance, a little detail that relates to income that the book doesn't directly discuss in this chapter, if you happen to be using the book as a guide here. But let's think about wealth, okay? I think the straightforward effect is when wealth goes up, demand goes up. Okay? And that's going to be true in general, okay? In general, this is going to be true. The higher the wealth, the more likely you are to buy bonds, okay? However, that's not the only effect, okay? There is a second, more obscure effect that occurs here, and it has to do with the way bonds are taxed, okay? So there's really two types of bonds, okay? There's municipal bonds. And these are governmental bonds, traditionally at the sub-national level. So this could be state bonds, city bonds, county bonds, and so forth. And what's unique about municipal bonds is they're not subject to income taxes. Or any taxes for that matter. So if you make a $1,000 profit on a Milledgeville bond, right? You loan money to the federal government, to Milledgeville by buying a city-issued Milledgeville bond, and you make a $1,000 profit, you're not going to pay federal income taxes on that, okay? And you're also probably not going to pay state income taxes. That does depend on specific state rules. But as you probably know, income tax rates are a lot higher than state tax rates. So even if you're in one of the states that's not real kind when it comes to taxing bonds, there's still going to be this effect. As your income goes up, which is not the same thing as wealth, okay? Income is what you earn in a year. Wealth is kind of like your overall net worth, okay? Obviously, they're correlated, but they do not have to be the same. So as your income goes up, that is going to make your demand for municipal bonds go up the most. So you're going to get a big increase here, all right? The reason for this is the tax brackets, right? If you're earning very little, you effectively pay a 0% tax rate on your income, okay? But as your income rates go up, that grows and grows and grows. Bonds usually are taxed as income, not as capital gains. So this could be a pretty high rate, in the upper 30s% in the United States. So if your wealth is high and your income is high, you're likely to buy more bonds. But also you're likely to shift and buy more municipal bonds, okay? On the other hand, corporate bonds, which are the other primary type of bonds you would buy, corporate bonds are always taxed. So what that means is when your income is lower, if you want to buy a bond, you're probably going to be buying corporate bonds to take advantage of the fact, all right? Now you might be thinking, why would you ever buy corporate bonds, okay? Here's the thing, all right? The wealthier people, the people with high incomes, they're going to be buying the municipal bonds to such an extent that it actually drives down the price of these bonds, right? If there's a lot of people with high incomes buying these bonds, the bonds are going to be low priced here, okay? The bonds here are going to have a high price and thus a low interest rate. If lots of people are buying something, right, that drives up its price, that drives down its interest rate. So if you're somebody who has a very low income and faces a very low tax rate, that is going to make the corporate bonds relatively better. I wanted to point this out because this is a big deal in the United States, all right? Income tax rates vary significantly. At the bottom, your tax rate is 0%. At the top, your tax rate can be, 38%, I want to say? Something like that. So there's a big difference there, okay? So wealth has a positive effect in general, all right? But that effect may differ when you think about the specific type of bond you're talking about. In other words, as your income goes up, your demand for corporate bonds may very well go down. All right, so in general, wealth, this is what we see for the bond market in general. When your wealth goes up, okay, price will go up. That means the interest rates go down, right? These run in inverse of one another. And the quantity here will increase. So higher wealth, higher prices in the bond market, lower yield, lower interest rate in the bond market, and a higher quantity in terms of the number exchanged, all right? That quantity goes up because as demand for bonds rise, pushing the interest rates up, okay, pushing the price up, that causes more bond issuers to issue bonds, right? Okay, if I'm thinking about borrowing money, I'm more likely to borrow money when the price is high and thus the interest rate is low on borrowing money, all right? So that's the wealth effect. The rest of these we can move through pretty quickly here. They're all pretty straightforward. There's our old friend again, inflation. Inflation affects both sides of the market, right? Everybody cares about inflation. So expected inflation matters too. If we expect inflation to go down, that is a good thing for the buyer of bonds, okay? What that means is if inflation goes down, all else equal, that means the payments you get in the future are higher in real terms than they would have been if inflation had stayed the same. Okay, let me say that again. If inflation goes down, that means the payment you'll receive on your bonds is the same in nominal terms, but it now is relatively high in real terms. Okay, so if people expect inflation to go up, that drives demand up, that drives the price up, interest rates down, quantity up, okay? Demand up, like we see over there, price going up, thus interest rate going down, quantity increasing, okay? So expected inflation, if it goes down, that increases demand and simultaneously would decrease supply if we think about what we saw in the last bit of this video. Well, if expected inflation rates matter, you would also expect expected interest rates to matter. And we're going to think about it this way. The returns relative to other investments. And we could think about this in two ways, two similar ways. If we want to make this look like our the last portion of this video when we talked about the supply side, we can think about this in terms of future interest rates changing. Okay, so you always have the option just to wait and buy bonds later. Okay, so returns relative to other investments could be future investments in this case, right? So if I think that interest rates are going to go up tomorrow, if I think that prices in the bond market are going to go down tomorrow, the other investment I could choose to buy is tomorrow's bonds that are being issued. Or it might not be about time. It could just be a different asset class, okay? So it could be some other investment. Maybe real estate. Maybe stocks, all right? If we think the stock market is going to be very strong over the next month, that decreases our likelihood to buy bonds because we'd rather have stocks than bonds in that case, okay? So simply put, if we want to just think about a simple example here, if we expect interest rates to go down, all right, that's the same as saying, all right, so AKA, if we expect bond prices to go up, okay, that's saying the same thing, right? Expecting interest rates to go down means we expect bond prices to go up. In that case, would that make us more or less likely to buy a bond today? That would make us more likely to buy it, right? Okay? Because we'd rather buy it now while interest rates are relatively high. We'd rather buy it now while bond prices are relatively low, okay? So the effect there is that demand would go up and we'd get those same effects that we saw in the last set there, all right? Similar to this, all right, a different real-world example, but ultimately something that would have the same effect here, okay, is if we expect, for example, the Canadian stock market to perform poorly, right? This doesn't just have to be a U.S. thing. It can be any type of asset that we're thinking about. If we expect the Canadian stock market to perform poorly, there will be some investors who stop investing in the Canadian market. And then they're going to invest in other things instead, including U.S. bonds, right? So I'm thinking about buying Canadian stock. I decide I don't want it because I don't think it's going to do well. Now I have this money freed up. Maybe I use some of it to buy bonds, okay? So we get an increase in demand. So basically, there are choices. There's substitution effects here, right? There are income effects when it comes to buying bonds, and there are also substitution effects when it comes to buying bonds. Thinking more about the availability of other assets. It's not only the value of expected returns for other assets, all right? When we think about what we're going to invest in, expected return, EV, is not the only thing we think about. We also think about standard deviation. So it matters if bonds are risky, but it also matters if other assets are risky, right? If I've got $100 in my 401k that I have not invested, the risk of everything matters to me when it comes to making a choice. So number 4 is the risk of bonds relative to alternatives. Again, all right, most people are risk averse, right? That's actually an assumption we have to make for this to be true, okay? If people are risk neutral, all right, risk will become irrelevant. people are risk loving, well, then they'll be seeking out risk. That's probably not going to happen. Generally speaking, people are risk averse. So what that means is when bonds become riskier for any reason, when bonds become riskier, people are less likely to buy bonds. If people just perceive that bonds will become riskier, or they think that there's something about the economy that will cause currently issued bonds to become riskier, that will cause them to buy bonds less often, okay? But again, it's not just bonds, it's other assets as well. So as a very clear-cut, a very real-world example, this has actually happened recently. If the stock market, and people expect stocks to be very volatile. You don't have to go very far back in time to think about this, okay? Right now, as I'm recording this video, it's 2021, but if we go back to 2020 when COVID first hit, the stock market was incredibly volatile, right? Not only did we have a big drop in, around March, we also had this big climb back in April. Several of the biggest drops in U.S. history happened in 2020, and also several of the biggest daily gains happened in 2020. So since people are risk averse, okay, they may have decided to stay out of the stock market. And indeed, there were a lot of people who did that. There's a lot of people who said, I'm going to wait it out. I'm going to wait for prices to drop further. Well, waiting for the stock market to drop means your money is elsewhere. And for a lot of people, their money was in bonds. And in fact, during that period, we saw big increases in prices in the bond market as investors shied away from stocks and moved more towards bonds, driving up the price. All right. So simply put, if people expect stocks to be more volatile than they used to be, the demand for bonds goes up. Okay. Again, that's assuming people are risk averse, but we know that's roughly true in the real world. Number 5. When it comes to any type of asset, people care about returns. That's obviously extremely important. They care about risk, also extremely important. And then there's a third thing they care about, which is generally not quite as important, but completely relevant nonetheless. And that is the liquidity relative to alternatives. Remember, liquidity refers to how easily you can access funds, how easily you can turn funds into cash. It's basically the ability to get out of your investment and get the money in your hands, okay? So we can think about for bonds, right? If I told you I'm going to sell you a bond, but you cannot sell it for a year, that bond doesn't sound very good, right? If you don't have the ability to sell that bond over the next year, you're going to, in general, prefer not to have a bond that's illiquid like that. On the contrary, if you have a bond that you know you can easily sell at any given moment, you're more likely to buy that bond, all right, knowing that you might need to sell it at some point in the future. So again, it's not just about what happens to bonds, it's also the relative nature of other types of accounts, okay? So as an example, let's imagine that the U.S. stock market will be closed on Friday. Let's imagine that there's an announcement. I don't know who would make this decision, but let's imagine that there's an announcement that the U.S. stock market will be closed on Fridays for the rest of the year, right? Something that could change, right? The stock market is not open all the time. In fact, it's not even open most of the time, right? It's not open on weekend, not open on holidays. It's only open during the regular working hours. So we might decide to go ahead and take Fridays off of this as well. This makes stocks a little bit more illiquid, all right? You need some money over the weekend? Well, you're going to have to sell stocks on Thursday. There's a 3-day period there where you can't make any transactions. So if you need money, you're going to have to wait, okay? What this would do is this would drive up demand for bonds. All right, this is kind of a silly example, but nonetheless, it's absolutely relevant, okay? If stocks become more illiquid, people are going to be more likely to buy bonds, ceteris paribus. All right, so we've got supply, we've got demand. Let's toss them together. Okay, so now we've got supply, we've got demand. We can now do the obvious thing and put those things together, right? Put the supply and demand together and think about what's going to happen in the bond market in general. So we'll start with an easy one, and then we'll move on to some that are a bit more complex. So number one, let's imagine that Mexican bonds experience high default rates. We're going to learn more about defaults in the future. It's a simple idea. A default just means that the bond owner, or rather the bond issuer, stops making payments. Okay, so let's think about how default rates in the Mexican bond market would affect the U.S. bond market. Okay, as a person that's borrowing money, right? Someone who's issuing bonds, you don't really care about this, right? If I'm starting a restaurant in the U.S., I don't really care about the Mexican bond market in terms of my bottom line. But as an investor, you do, okay? So if we think about bonds in the U.S., all right, to be clear, we're thinking about domestic bonds in this case. What this would do is it would make you recognize that the risk of Mexican bonds is now greater than it was in the past. So U.S. bonds are now going to look comparatively like very good options. So the effect is the demand would increase, leading to a higher price, leading to a higher quantity. On the quiz, on the exam, be prepared to tell me what's going to happen to the price, the quantity, and the interest rates. Okay? So that's a simple first example. The second example. Another pretty easy one, but I also want to use this opportunity to introduce another topic here. A second possibility is the U.S. government issues stimulus checks, to fight a recession, maybe to fight the economic effects of COVID. The government could issue stimulus checks. Now, where are they going to get the money? Okay, they're going to get the money by issuing bonds, by borrowing. All right, so if they issue $2 trillion worth of stimulus checks, that is $2 trillion worth of bonds entering the market. We talked about how the government can move the needle. $2 trillion worth of bonds will absolutely affect the market. So here are the effects. Here's supply, here's demand. Equilibrium here. The effect of this change, the effect of these government bonds issuing the market, is we get an increase in supply, okay? And what that will do, of course, is it will lower the price and it will increase the quantity. The reason this is a supply issue is we're thinking of the government as being part of this market. So you suddenly have this burst in terms of the number of bonds being for sale, right? The supply curve now has more in it because of these governmental bonds being issued. So the price is going to go down, interest rates go up, and the quantity increases. Now I want to use this opportunity to think about what this does to the market, okay? Think about how this affects private borrowing. When the government does this, when the government goes in and they issue these bonds, as someone who sells bonds, right? As someone who issues bonds, borrows money, do you like this or not? If you're thinking about issuing a bond, this is not a good deal for you, right? This is going to lower the price. And keep in mind, lowering the price means you're lowering how much the borrower receives. So if I'm issuing a bond that's going to pay $100,000 30 years from now, the amount of money I can get for that bond today has just gone down. Borrowing money has just become more expensive. So what this does is we get a reduction in private borrowing. Okay? Now why don't we see that effect here? Why do we see quantity go up? Well, because we're including the government here. But let me show you what happens to private borrowers. If the old supply curve represents just the private borrowers, okay, it represents where we were in the past, then that new supply curve is only showing the effect of the government adding into this market. So if we take a step back, this is kind of an unusual thing. We don't normally think about two curves simultaneously. But think about it. Think about if the interest rate had gone up and the price had just gone down for any other reason, okay? Thinking about where we were on our old graph, if the price had gone down, this right here represents the amount the private issuers would have sold, okay? So this is the amount they're willing to issue. And nothing else has changed except the government is now issuing more bonds, all right? So this interest rate that we're at and this price that coordinates with that interest rate, okay, that P2 right there, that shows us the price if that shows us the price after the government started borrowing more money, okay? If we revert back to the old supply curve, it will show us how much the private companies and the private companies alone would have sold at this rate, okay? So actually that right there shows us the amount the private issuers are issuing. And the government is actually issuing all of this, okay? So all of that represents the government borrowing, issuing, selling, whatever you want to call it, right? Borrowing of funds, issuing of bonds. All right, so what happens here is when the price goes down, there's really two effects, right? One, the government issues more bonds, right? So we get more quantity. But two, since the price is lower, private sellers of bonds get scared away, right? They don't like the fact that they're going to receive so little in compensation. So they issue less, all right? So ultimately, here's the thing. Anytime the government borrows money, the private sector borrows less money, all right? I sometimes kind of like to think about it this way. You know, imagine you're walking to the bank, you've got $1,000 and you're walking to the bank and you're about to buy bonds with it. And on the way, right before you're going to buy some corporate bonds, the government offers you a sweet deal on that $1,000. They offer to sell you a better bond. So your money never makes it to the corporate bond. The government buys it first, right? And as the government's going around and they're buying and they're issuing all these bonds, right? When they're issuing all those bonds, they drop down interest rates, okay? They raise interest rates, right? When the government is issuing all these bonds, that raises interest rates. That causes all these private investors to fall off the bond market. They don't want to issue bonds if the price is going to be really low and interest rates are going to be really high on those bonds, okay? There's a name for this. This is called indirect crowding out. This is a term you should have seen in your Principles of Macroeconomics course, but perhaps you didn't think about it in this graphical fashion. This is kind of a complicated graph. I'm mixing my words up as I'm trying to talk about it, right? Because there's so many moving parts. But if we want to take this complex idea and make it as simple as possible, which I think is always a good idea when it comes to economics, the simple idea here is when the government borrows, they steal funds from the private market. And this is certainly an unanticipated consequence of government borrowing, okay? So although we see an increase in quantity in the bonds market overall, the increase in quantity is coming at the expense of private borrowing, all right? The government is stealing away some of those funds, right? This drop right there, right, that went from QE to this new level here, that represents the decrease in private borrowing that occurs. And again, that is called indirect crowding out, okay? It makes government spending sometimes not such a good deal. A third example. All right, now the ones we showed so far just showed supply changing or just demand changing. Those are the easier ones in terms of just thinking about what happens to price and quantity. It can get more complicated when we think about both supply and demand changing. So for example, let's imagine that everyone expects inflation to go up. All right, now don't get in your head thinking about what's going to happen to interest rates too, okay? Keep in mind this is ceteris paribus. Imagine nothing else changes except people expect inflation to go up. So don't imagine anything else changes, just this, all right? The thing about this effect is it's going to affect both sides of the market. Whether you are buying bonds or selling bonds, either way, you care about this change. Okay, so let's think about what the effects would be here. Let's start with the supply side of the market, all right? If you expect inflation to go up, does that make you more or less likely to sell bonds today, all right? So what that means is I'm going to pay the same amount back in the future. Bonds, once you've determined what the interest rates are, those lock in, okay? So if I'm paying a 4% interest on the bond that I'm issuing, it's better for me if inflation goes up, all right? So the effect is, if people expect inflation to go up, they will be more likely to sell bonds, all right? Conversely, everyone expects inflation to go up, so this might also affect demand. And of course, consumers of bonds, they do care about inflation rates. If inflation is higher in the future, that means their payments are worth less, all right? So that reduces the demand, okay? So what happens here? I want you guys to be careful here. This is, something you should have seen in microeconomics, but keep in mind, what we've got here is supply going right and demand going left, all right? Supply going right, demand going left. Those are opposite forces. So we actually don't know what's going to happen to quantity here, all right? If it's a multiple choice question, options could be quantity goes up, quantity goes down, quantity stays the same, or we don't know, all right? We do not know, okay? So don't draw this and say, based on the way you drew it, it shows it's not changing, or based on the way I drew it here, it looks like it goes up a little bit. No, it doesn't matter how you drew it specifically. The bottom line is, supply is going right, demand is going left, and we don't know which of those effects is bigger, okay? So we don't know what's going to happen to quantity. On the contrary, we clearly know what's going to happen to price, all right? In a way, it's kind of like demand's going down. It's shifting this way, so it's kind of like demand's going down. Supply is shifting right, kind of looks like it's going down, all right? Both of these effects are moving in the downward direction. So although we don't know what's going to happen to quantity, the effect on price is unambiguous. Price will go down, okay? Also, we can say inflation or interest rates will go up, all right? Which is kind of an interesting result. So what this shows you is, when you normally think about inflation makes prices go up. That's true for most assets. But in this case, what you see is actually inflation causes bond prices to go down. And that's consistently seen over time. This is not some sort of weird, archaic idea. No, this is proven again and again that this is the case. Let's just do one more, okay? Really, what you have to do with all these types of questions is you have to practice them. So, I could go through and do tons and tons of examples, but the best thing that you can do is work through these on your own. And I'm going to give you a ton of practice problems you can do here. Work through these on your own. That's the only way you're going to get good at this, okay? In the past, when I've taught this, students didn't do very well in the first quiz because they didn't try hard enough. By the time they got to the exam, they were doing quite well, all right? I'd rather you go ahead and do well now, all right? So go ahead and practice these types of questions as soon as you can. All right, so one more effect, just to keep you guys on your toes. Let's imagine that wealth goes down, and at the same time, stocks are expected to rise in value. So basically, in the U.S. market, wealth is going down, and at the same time, stocks are expected to go up in value. And there's a reason why I'm including this. I used to not teach these types of questions. I used to just ask them on the quiz, but I got so sick of people missing these, okay? The thing in economics is, things don't come in these nice, neat, consistent, predictable ways, okay? You get used to seeing these things that affect supply and demand, and then we do these questions where supply and also demand are affected, like the last example we did. But there are also times when just demand or just supply are affected by multiple things at the same time. And that's what you see here, okay? Both of these effects are actually demand-based, all right? Just because I put two effects doesn't mean one's going to be for supply. These are both demand effects. when wealth goes down, all right, what that does is it causes demand to decrease for bonds in general, right? We also could think about how this would affect municipal versus corporate bonds too, you know, be prepared for that type of thing. So wealth goes down, demand would decrease, all right? On the other side, if stocks are expected to rise, so stocks are expected to rise in value, all right, that would cause demand to decrease as well. Okay? So actually it's the same effect. Demand decreases in both of these scenarios, all right? So what ends up happening is, despite the fact that we have two effects, they move in the same direction, right? So you ultimately it's just a decrease in demand, okay? It's not especially hard, but I'm just warning you because in the past, I've had students see these types of questions and they just assume that one must be for supply and one must be for demand because they've seen those types of questions in the past, all right? If I change this just a little bit, let's say that wealth goes up, all right, causing demand to increase. All right, well now we've got two opposite effects. So what's going to happen? There's no telling, right? We don't know what's going to happen to the price, interest rates, quantity. We don't know anything because we don't know which of these effects are bigger. So anytime you see supply or demand have effects that move them one direction and then move them back, we don't know how big those shifts are going to be. So in reality, we have no idea what this is going to do. All right, it's all question marks. Like I said, the key here is to practice. All right, work through these. Spend some time. It's tedious, but work through these, and it'll make you more informed about how financial markets work. Bonds are a big deal, and this is showing you where those interest rates come from, specifically in the bond market.